Hey, welcome to Exchange. Let's take a look at the foreign exchange market and also US dollar strength, what this means for the European and Chinese economies, and really find out what it means for average US consumers and average US equity holders. So I pull up here, this is the European USD Forex or currency chart. Basically, all it really means is for every 1 euro, you can get 1.05 US dollars, which it's been above one for forever since roughly the 2000s time frame, but it really has been about 1.2, 1.1, somewhere in there. I mean, you see in the past month or so, it's just dramatically dropped. This is a 5-year chart, so if you go to the all chart, I mean, we're about to break down really the unknown territory back to 2000s potential level if this falls much further. But really what we've seen in the past, is for all currencies, is really massive US dollar strength with a European, Chinese, Japanese kind of basic currencies collapse. Let's go to the Chinese yuan right now. So this is a flip chart, so basically saying for every US dollar, you can get X number of Chinese yuan, which is their currency. And you see right here, I mean, average, it's been around roughly at 6.35 level. Now we're at 6.59, which is, I mean, this is a massive move. This is a 1-year chart. Let's look at the 5-year chart. I mean, look at that vertical spike. I mean, it's literally a hockey stick straight up to the moon. It's really got the Chinese central banks actually very, very nervous of like what they're actually going to do, because basically what happening is you're seeing a massive currency devaluation, which they don't want. They want some currency devaluation is fine for them, but they don't want to see massive hockey stick level devaluation. Especially right now, I did a video earlier about the Chinese real estate bubble, and that's, I mean, this is one of those things where you think about collapsing Chinese economy. This might be a catalyst for that potentially to basically drive the entire kind of bubble basically down, whether it bleeds down or just explodes all at once potentially. Now, China was very interesting, though, too, because last week they basically dropped their foreign exchange holding rates for their domestic banks, which all that means is basically drops the foreign amount of foreign money they have actually in their reserves. So what that means is they can sell U.S. dollars and buy Japanese or Chinese yuan, which is good. It helps basically prop up the yuan, which, if you look at the actual graph here, it should cause this number to spike down potentially if it works. But the problem is, I mean, it's been such a violent move there where they have to have major policy changes in order to actually save the yuan and keep from devaluing too far. But again, we'll see though too. I mean, if it goes anywhere near like the actual pre-COVID levels where it's like around that 7 mark right there, I mean that's gonna be almost like a red alert basically for Chinese either recession or major Chinese restructuring financially. So China right now is really in a self-imposed short-term recession with these the Shanghai or Beijing lockdowns, which, I mean, that's going to last not too much longer. But the question is, as it come out of that, as lockdowns lift, will the economy actually rebound? And right now, the answer is almost like a slightly no or a strong maybe. We're not quite sure. It's definitely not for sure yes. The Chinese yuan, the way it's moving right now, I mean, it shows that, hey, almost recessionary fears, almost like peak COVID back in March 2020 kind of level fears potentially. We're seeing capital flight to the U.S. or European markets from some of their basically their equities going out. We're also seeing too potentially looking at Europe. I mean, Europe's in a whole different situation right now. So we might have a potential European recession based on energy and also food prices in general. So basically what that happens is for average household, European household, as food and energy go up, consumer discretionary goes way, way down. So it's almost like a energy shock / food shock that could be causing a major recession, especially for some of your poor countries around the EU. And then this Ukraine war, looking at that right now. So really, I mean, it's not anytime soon. I mean, if nothing else, it's going to bleed out Russia potentially. So, I mean, long-term NATO is going to win. It's just a matter of how they're going to win, how easily they're going to win potentially. But I mean, that's a long-term play. And also the energy price kind of shock we have now where it's elevated energy prices, that's going to last probably throughout the summer, which is like peak travel season for most of the world, including the U.S. So the question is really, how is this in for Europe? Because right now they're still in quantitative easing, not quantitative tightening. So they might be easing into the recession, and then once they actually want to tighten, 3, 4, 5 months from now, all of a sudden they're in a recession. Are they going to tighten at all potentially? I mean, or to save the European economy? I mean, this could be a massive, massive collapse within Europe, which is totally separate from China too. It's almost like 2 separate recessions for 2 separate reasons. But obviously, linking there is COVID in the middle a little bit, but it's not nearly as bad as in Europe as it is in China right now. So here's really the big question I have personally as an investor too, is what does Jerome Powell do with a Chinese recession and a European recession while they're basically quantitative easing or quantitative neutral right there, and he still wants to go heavy quantitative tightening. So this whole idea of like, hey, 3.5, your federal funds rate, go to the neutral rate, et cetera, we're having like 16, 17 rate increases. I mean, even this summer, looking at 0.5, 0.5, 0.5. Really the question is, what does he do, hey, midsummer if we hit? And it's very obvious that China and the European Union are in a recession right there. Was the U.S. keep tidy potentially too? I mean, could see a U.S. growth slow down potentially. We're seeing the early phases of it right now, and there's a lot of fear right now across the entire U.S. market. But really what he needs is an inflation miss. He needs basically a deflation number to come out where it's, hey, strongly correlated, where it's, hey, this is happening, where the U.S. economy is slowing down, and prices are dropping across the board for U.S. consumers, which will help both politically and economically for the U.S. right now. But again, these are all massive questions. I mean, he doesn't have the answers, doesn't have the data quite yet, but this is one of the fears I have personally too. But my big fear is also we start seeing this data this summer, and he's gung-ho for quantitative tightening, and all of a sudden enter a U.S. recession and or U.S. depression. Now, it would be interesting to see this summer, once we get the data of the Chinese-European recessions, if they happen at all, potentially, is really what Jerome Powell does. Because, I mean, this is one of those things where it's hard to keep raising rates aggressively, especially when you start seeing numbers start coming down potentially for inflation, start seeing like smaller and smaller prints. I mean, we're still going to have inflation. It's pretty sticky for the summer time frame. But, I mean, again, looking at like Chinese imports or some of their foreign exchange, basically these foreign exchange kind of currency imports you could have potentially. I mean, there's a lot of deflationary pressures on the horizon, and he knows that too. I think he's trying to just buy time. But the question is, what happens really once these actual numbers start coming in very, very negative from international markets, etc.? Is he stop raising rates, or is the actual 17 or 16 rate increases all of a sudden drop to 8 or 9 potentially, or 6 or potentially 2, and also we go almost more neutral second half of this year, while also maintaining really the federal fund or the Federal Reserve balance sheet kind of runoff. So that's one thing where I could see the summer second half where it's all of a sudden the federal rate increases basically halt or stop or slow down dramatically while still maintaining the federal fund balance sheet basically ramp down, which again, that's pretty negative for the U.S. market though too. But I think even having the federal funds rate go more neutral earlier on in 2022 than people saw, because right now they're saying, hey, by 2023 we'll have the 17 rate increases, which I think is way too high. I think that's a lot of fear talking right now. The U.S. market right now is very fearful, but I mean, I think long term we're going to see a much more balanced U.S. policy around 2% potentially. These inflationary pressures we're seeing right now are not going to last. I mean, it's just a matter of when they actually last, or when they actually start collapsing. Which I think we're getting to that point now where it's, hey, we're starting seeing the major recessions in Europe and China. So I pull up here. This is a 10-year bond chart. It's a little bonus content. Oh, you're thinking, hey, 10-year bond does not matter, but give me 1 second here. So basically, the Japanese bank keeps a 10-year bond in a negative 0.25% yield and a positive 2.5 or 0.25% yield kind of bracket right there. That's kind of their target focus right there. What all that means is that the 0.25, which they're pretty near it right now, it means, hey, they keep buying and buying and buying until the actual yield drops. It's basically a bank policy they have in effect to kind of keep their yield pretty stable. The question is potentially if it bumps up against that 0.25 yield, if it breaks out potentially and start having like real yield in Japan, what happens next? Which you're thinking, hey, it's 0.25, it's not much yield at all. Like, why would people do that? Again, people want to keep Japanese people want to keep their money within Japan if possible. It's just easier to deal with that way. Start having real yield in Japan, it's basically more of an incentive to keep your money there. Which, hey, why does it matter? Well, the Japanese basically population is actually the biggest buyer of U.S. treasuries as a foreign market itself, besides China. So what you're seeing right here potentially is if the demand all of a sudden drops for 10-year treasuries, all of a sudden the price could skyrocket. I mean, you could have well above 3% yields across the board. So it's definitely a near-term risk for the kind of the bond yield spiking up, which obviously if bond yields spike, auto loans go up, houses go up, etc. It could be very, very bad for the U.S. economy. Hey, but that was a lot of content. I mean, let me know what your thoughts on this one. I mean, especially if you think European and Chinese recessions are going to happen this summer potentially. And you're like, really, what do you think Jerome Powell is going to do this summer? I mean, if anything at all, potentially too. I think the biggest thing I really look for, again, it's a deflation, kind of a deflationary print potentially, or inflation miss, etc. What's going to happen there? Which it's going to happen. It's just a matter of really when it happens. Because right now, I mean, it really is like peak fear, peak inflation fears, peak recession fears, etc. I mean, everyone's just really wound up tight, and you're seeing that in the U.S. market volatility just day to day. Also, earnings are starting to miss a little bit too, which is usually a bad sign for kind of a pre-recessionary environment overall. But yeah, definitely sub, like, comment down below, and yeah, that's the exchange.